You take care of that. And they're probably going to take about 10 minutes.
Okay, if everybody will settle down, Kevin is going to be handing out the evaluations for the course. You have to turn them in. Don't let me see what you're writing and hand it back to Kevin. We'll give you 10 minutes for that, and then tonight's speaker will start. Sorry about this. So they should be fine. Anybody not have an evaluation form? Because there's spare ones up front here. Charles, you want to fill out my Sorry? There are some courses where these things matter. The only thing actually is one requirement. And we were typing like so far, the experience is the only thing Anybody not filled out your evaluations? Now, normally for a course that's been done this long, given by a professor they can't get rid of, they don't matter at all. But in this case, because we did this innovation with the questions, it actually matters. So if you haven't done an evaluation, we want to see them this year. And in particular, we want to know how you feel about how the questions worked, or you prefer. Well, those of you who don't show up for your questions, it's got to be a big improvement, right? But whether you prefer to do the old hand in the air or not. So is there anybody who has not done an evaluation who would like to do one, or is there anybody who hasn't completed it yet? Okay, I want to say something about Lilu briefly, and then I want to introduce tonight's speaker also briefly, because he doesn't really need much of an introduction. It should be clear to you who Lilu is most like that you've heard from before, which is Glenn Greenberg. He holds a small number of positions. He holds them in theory for a long time, and therefore he knows a tremendous amount about the companies. Now, the interesting difference is, and I don't know if this was directly apparent from what he does, Lilu almost always starts small. That his basic technique is to learn about these companies relatively slowly over time. That's why what he stressed was knowing what you don't know. Because if the process of understanding these companies is a matter of slowly diminishing your areas of ignorance, if you don't know what those areas of ignorance are, you're not going to make progress. You ought to contrast that with the way Glenn talked about these companies. What are the 3 critical questions that he has to know the answer to? It is not, in his case, a continuous process. There's a lot more thought and analysis up front and a lot less of a continuous process of learning about the company. So at this point, I think it's fair to say Lilu knows as much about BYD as everybody but the head of the company. And essentially, by the way, what he was telling you is that there are incipient products and projects there that are of collectively probably a very high expected value. So even though superficially it may look fully valued, especially if you don't give a lot of credit to the auto division, there are lots of other initiatives there. But I think the thing you want to stress is, if you think it's a style that works well for you, is this aspect of absolutely continuous learning. It means that you may buy and hold a small position for 2 or 3 years before you expand it. Because you're conscious of what you don't know, and you learn slowly over time, and you may never expand it if you never get comfortable with the company. As opposed to, in Glenn's case, you go through a lot of companies, you pick the ones that look attractive, and you make large bets on them almost as soon as you have confidence in the analysis. So those are 2 approaches to concentrated investing. As I say, I think you'd probably do well to do some sort of intersection of those 2 approaches. Tonight's speaker has 2 things that distinguish him. First, he is our most direct connection to Benjamin Graham. He was Ben Graham's stockbroker when he first started in an office in San Diego, and learned on the basis of that. Now, in his case, too, he did not stop with what he learned from Ben Graham. He is also one of the pioneers in international applications of value investment. He tells me he did it first in 1974, but that was with 1 stock. My impression is that he actually started a global fund in the early 80s, which is before Tom Russo or any of the other people who've gotten into that. So with that as background, Charles Brandis, you're on.
First of all, I'd like to say there's a lot of Brandis Investment Partners people here. We have some of our former research associates here in the class, and we have some other who work for us, and we have also another Brandis partner with us. Ralph Berkmeyer sitting right here.
No.
Ralph, you took this course 10 years ago?
I graduated here in '99 and took this course. I snuck in the first year and took it legitimately the second.
I see.
Yeah.
And Bruce was a lot younger than us.
Yeah, but not much
Equally
smaller.
Well, when the questions come and they're really hard questions, I'm just going to ask Ralph to answer them. Bruce, we're really happy to have Ralph as one of our partners, and whatever you had to do with his education, thank you very much. It was kind of what Bruce mentioned. It was kind of happenstance, but just a great thing for me. Just a little brief history lesson. Actually, Ben Graham walked into the office where I was a stockbroker back in 1970, and he wanted to buy one stock. And Bruce called me his stockbroker, but I only had one trade with him. Wasn't exactly Ben Graham's stockbroker, but he walked into the office that I was in La Jolla, California, and he wanted to buy National Presto Industries. And I can remember exactly the trade, of course. I bought him 1,000 shares of National Presto Industries, and the reason he was buying it, it was a net-net. And it was quite an amazing net-net at the time. They made artillery shells during the Vietnam War, and they also made waffle irons and things like that. And over since that time, that was 1970, 71, National Presto Industries. I haven't looked at it lately, but it's been a net, and it's been around for a long time, and nothing's ever really happened with the company. It's kind of amazing. The other happenstance, that was a great happenstance, because I met him right after the 1970 bear market. Being a rookie, starting in 1968, I didn't know anyone. And I didn't go to Bruce's class, so I knew nothing. And at the 1970 bear market, the market was down 45%, the S&P 500 top to bottom. That taught you a lot. And it was very early in my career that I got taught a lot about investing by that terrific bear market. And that's when, right after that is when Ben Graham found that National Presto Industries was a net, and he was going to buy some. Of course, he used that as an example of a net in his book, The Intelligent Investor. So I met him right after that, and that was the greatest thing, because I had this experience of a bull market and a bear market, and then I started to go back to read his stuff, which I did read a little bit in graduate school. Didn't hit home at all. Didn't mean anything to me. I had no experience. And the light bulb really went off then about the Graham principles, and I've been following them ever since. The other fortunate just happenstance is that when I was a broker, my first client was a foreign gentleman. He was actually from Canada, and he had some money also in Europe, and he wanted me to invest not only in U.S. stocks, but he wanted me to invest internationally. So that's how I got into it. There was a client asking me to do it. It wasn't that I was so brilliant to know that would be a great thing to invest around the world, not in the U.S. Especially if you think about the early 1970s, U.S. market, I don't know the exact statistics, but I think it was more like 80%. 75 or 80% of the world's markets were the U.S. factory. Of course, now it's changed, as you know, dramatically. What is the U.S. now? I don't know, 40%, something like that. So investing as a U.S. person internationally has been a very, very good thing to do. Before I would like to take maybe about 15 or 20 minutes to talk about something that is going on right now in our business. And I wanted to talk about this because it's affecting us at Brandis Investment Partners. And there's a couple of things I wanted to talk about that's affecting us right now. That is, number one, there is, after the 2008-2009 markets, there has been in the investment world, institutionally and in the high net worth client, we have both, although we have mostly institutional clients, there is a move toward giving up. And There's thoughts that the market is much too volatile and it is too dangerous, too risky, and we shouldn't be concerned about trying to outperform the market because nobody can. And we've seen a lot of good active managers underperform the market in the last few years, so they're giving up. And there's a big movement toward indexing. And I'd like to talk about that a little bit. Also I would like to talk about the fact that good investors, and this has been true for a long time, very, very good long-term investors, very good Graham and daughter investors. Warren Buffett talked about the super investors of Graham and Dodgeville and how they underperform. And there's going to be at least 40% of the time, according to some of the statistics, that very, very good investors underperform. The clients don't understand this. The clients are never going to understand this. And when you are underperforming, the clients are getting very upset, and the clients are firing people right and left. And that's the way in the investment world it always happens. When you have clients, because of their behavioral aspects, and behavioral economics, as you know, is a very big factor in value investing, and it's a very big factor, if not the factor, in being able to outperform over a long period of time, taking advantage of behavioral aspects. We have been underperforming at Brandeis Investment Partners for a few years right now. This is not unusual. Over the last 35 years that I've had the company, we've underperformed for periods of time 5 different times. So it's not unusual. And at some points we underperform by a year or two. Other points in the past we've underperformed by as much as 5 years. And we're in that condition again today. So I'd like to talk about that a little bit. So I'll get on with talking about the value of active management. And here's a little bit of what's happening. As I mentioned, there's a big rise in indexing right now. There is a question of managers all the time that smart people ask, is this manager really an active manager? Is he really trying to outperform with me? Or is this manager building portfolios that are protecting his business interests so he doesn't get too far away from the benchmark that he's doing? What I see in the investment world from consultants and from clients and things, that they are not very good in evaluating good money managers, and they're not very good in picking good active money managers who will outperform over a long period of time. They're just not there. And that is because primarily, as I mentioned, behavioral. And then because of that, I'd like to talk a little bit about the effect of emotions and behavioral aspects of what's going on today. Of course, the reason you would have why would you have an active manager? You want to outperform. That's the only reason to outperform the benchmark. And you want to be able to identify picking money managers, an alpha-producing manager over a long period of time. And you have to be able to stick with that manager during periods of underperformance, because it's inevitable that there are going to be periods of underperformance. And this is what I see as a very big problem today for a lot of the very good managers who've underperformed recently. Going about, so what is happening, a lot of people are going passive. They're giving up. Quite a few years ago, Warren Buffett said he's really happy when people go into the index, when they give up competing to outperform, because that gets rid of your competition. And that is really true. If you think about it, what would happen if everybody indexed and there was no active managers whatsoever? Well, you've got a very, very inefficient allocation of capital in the free enterprise world, and that would be a disaster if everybody indexed, who would be picking where capital goes? I guess the people who put together the benchmarks, the committees who decide what goes into the S&P 500 index, they would be the allocators of all of the capital for all the economies around the world. That would be kind of interesting. So when you think about the rise in passive funds, the rise in ETFs, and you take it all the way, what some people are saying, and some consultants are saying, you should give up. And this index, and don't worry about it because you will outperform all the money managers in the world just by indexing, is what they're saying. So where are we? 1.7 trillion is now in passively managed funds and in ETFs. Of the sector funds, and I'm talking about mutual funds right now, 35% of the total is in passive funds. Of all the mutual funds, and I'm talking about U.S. right now, 22% of the mutual funds are passive. They've given up, and those numbers have been going up recently very dramatically. The value of active management, what I've put here is, I mentioned to you that we are underperforming. But if you look back at our international portfolio, this is starting in 1990. The top line, of course, is us. That's by blue, I guess. And the bottom line is the MSCI EFA index. And the line below that is the indexes to the EFA index. And it's a very simple chart, but it just shows that if you go back for a long period of time, as Graham and Dodd value guys in the international markets, we've been way, way outperforming. And we have some clients right now who are putting us on the so-called quote watch, unquote, because we've been underperforming for a few years. So they're saying, well, there's something happened with this money manager. They're not looking at this kind of record, and they're not looking at what happens on recovery. If you see there from September 2006, where we had been way outperforming the index by unbelievable amount, then we came down a heck of a lot more than the index. So this is one thing that is perceived by a lot of people that value managers, and maybe some of them are, but it's not. We are a very active value manager, and we don't get scared about volatility, and we don't try to reduce volatility. So we're very volatile. And on the downside, this time, the thoughts have been value managers don't go down as much as the market. Well, we went down more than the market this time. And value managers don't always reduce volatility on the downside. That's a myth. And you can see our volatility on the downside there, 2008, 2009, was quite substantial. We bounced back, but we haven't bounced back anywhere near the highs yet. And we actually underperformed in 2009 in our international. I think the EFA in 2009 was up 31%. No, 28%. It was up, and we were up more like 21, 22%. So we're still underperforming. We're still under that kind of pressure right at the moment. So I wanted to talk about how do you evaluate a manager then, and one of the things I'm saying the investment world out there doesn't really know how to evaluate managers very well. You know what they're looking at is we're going to look at long-term performance. So we'll look at the performance for the last 3 years. That's how they evaluate a money manager. And one thing that they don't look at that I'd like to talk about is if you're going to outperform, and Ben Graham said this, if you're going to outperform, you got to have a philosophy. You got to sound, it is fundamental, that it makes sense. And that philosophy, you can't be doing what everybody else is doing. It's got to be different. And fortunately, that has been true of investing in this country and around the world. You can be fundamental, you can be conservative, you can have a philosophy that makes a whole lot of sense, and not everybody is doing it. It's still the same. The reason why there are a lot more value managers now, but the reason why it's not, in my opinion, going to affect the performance of value managers, it goes back to that behavioral aspect again. It doesn't change. And if you see the fluctuations in the market, the behavioral aspect do not change. This is it's called an active share, and how you manage to evaluate a fund manager, or this was to see whether he is really a closet indexer or whether he's really a very active manager. And this is much better than some of the terms that they're, some of the things they're using, tracking error right now. The consultants use tracking error. Tracking error is the standard deviation of the alpha produced by the man, and that does not really tell you necessarily how much active a manager is. But this does. What this equation shows is it takes every single security in an equity portfolio and compares it to the securities in the index, and the weighting, the W is the weighting in the portfolio or in the fund, and minus the weighting of the same stock in the index, and then you sum that for each individual position in the portfolio, and then you come up with what is called an active share. If the number comes out close to 100, that means it's totally active, totally different, 100% different from the index or the benchmark that you're using. If the active share is close to 0, that means it's an index. And this is kind of an interesting way to kind of look at long-term performance too. This chart we have taken the annualized alpha produced net of fees based upon the level of active share, whether they're 100 totally active or 0 not active at all. And I've broken it up into quintiles, and the first quintile is the most active, and that's an active score of 80 to about 100. And you'll see the outperformance. This is not just value managers. This is growth managers. This is combination managers of growth and value, or however they decide that they want to do it. But the active managers, of course, have outperformed since 1980. This is 1980 through 2003 is all we have on this. And the active managers, of course, are the ones who have outperformed. This is their alpha figures. And if you look at quintile 4, quintile 5, those are the managers that are the least active. And of course, they've underperformed and produced negative alpha. Because mostly that is because of the transactions and fees and costs, things like that. It's interesting what's going on in the U.S. mutual fund industry right now, as far as when you measure the mutual fund managers from the standpoint of active versus passive. And what color is it? It's kind of green. The green line is the 80 to 100 score on active, or the very most active of it. And you'll see going back to 1980, the percent of mutual funds that were active, they got up 1984, 1986, 70% of all the mutual funds that you judge them from active or non-active were active. And you can see that continues to go down since that period of time.
Now that's fund weighted, it's not value weighted, is it?
That's right.
Okay, so it could be those low blue funds are much bigger than red or green ones.
Yeah.
So the shares might look very different.
Yeah. Yeah. Okay. The bottom is purple. The bottom line is the least active, and you can see that that's been increasing as a percentage of everything that's going on.
Right, but if those funds have gotten much bigger, the increase is much larger.
Yeah. And I suppose, Bruce, what we could say here is that this would be somewhat positive for active management. You're getting rid of competition. You might say this could be positive development for the hedge fund guys, who are some of the hedge fund guys. I guess you could categorize them as about as active as you can get. And if the competition goes away.
Sort of.
Sort of, yeah.
Except that the problem here is that the truly 100% or 0% are the index funds.
Yeah.
And they underperform by their fees, which are
Right.
20 basis points.
Right.
So these guys are these quasi-active ones are much worse than them. And those are therefore really by definition the stupid guys. And the more stupid guys you have, the better. Right?
Well, yeah.
Because the one thing that's behind this is that when you add up overall investors, the average return has to be the average return. That's a record.
Well, that's, yeah.
So if to the extent that the active guys are the stupid active guys, I'm sorry, the inactive guys are the stupid inactive guys, it's much better for you.
Yeah.
To the extent they're indexers, it's not so clear it's better. Because if they're migrating from the stupid guys to the index funds, there's less opportunity for you. If they're migrating from the active guys to the index funds, then it's good. So it's a little more complex.
It's a little more complicated, but as you know, the indexes are weighted as the size of the company, so that the indexers move more money into the bigger companies all the time, which is inefficient and that could help maybe mid caps and small caps. In any case, this for us has been, we are pretty much of a pure Graham and Dodd bottom-up money manager, and we've done our own analysis of our portfolios as far as active or not active. This is as of March 31st this year. Our global equity was an active score of about 85%, or compared to the MSCI World was about the same, 86% compared to the MSCI Equity benchmark. Our international, about the same compared to EFA, it's 85% active, and compared to Equity ex-US, 89% active. So we're out there. We've got our. I was about to say something I shouldn't say it in class, but I haven't changed it. We're out there. We have it stuck out there ready. And because of that, as I mentioned before, we're underperforming over the last few years. And it's nature. If you're active like this, you have to be. But it's not anything that really is well understood. And clients don't well understand it either. It's pretty frustrating for us to have these questions from clients all the time. You know, what has happened to you? Why are you underperforming? What are you going to be doing differently? We get these questions all the time. And what did you learn over the last few years that you didn't know before? And I find it pretty frustrating, but we have to answer those questions all the time from clients. What we have done differently is practically nothing that we've done differently compared to the last 35 years. What we've done in making a few mistakes during the last market downturn, which we did, we actually had positions, small ones. We had positions in AIG and Freddie Mac and Fannie Mae. And that hurt us very, very badly. But we did do our very thorough analysis and kept doing thorough analysis of the situation. And my only excuse for that is the situation was quite unique from the standpoint of one standpoint was what we didn't anticipate, and that was a lot of government interference. And that was one of the main things why these companies, especially Fannie Mae and Freddie Mac, got into the trouble that they did. And we weren't too bright. In hindsight, you can say we were pretty dumb. But in foresight, we were looking at all of that very thoroughly. And when they got down to $1, $2, and $3 a share, we decided that they would have a potential recovery, and then the government came and took them over, and they did. The matter of short-term underperformance. This slide, they stuck it in on me. I'm going to skip that. But just look at some very good money managers, and all I was looking at here is mutual funds. And out of 120 mutual funds, 1999 to 2009, the 7 top performing funds, there are 17 top performing funds over that decade achieved a 5% or more rate of return. By the way, during that decade, 1999 to 2009, the EFA index had only done 1% a year. But you got to be careful in looking at this kind of thing, because we're starting in 1999, and that was during the internet bubble and the technology stock bubble, so you were very, very high. And we're ending in 2009 at the end of a very, very bad bear market. And so when you look at that, you can say the EFA over the last 10 years in international investing has only produced 1% a year. But if you take different time periods, the numbers can be totally different. So you can be lied to, obviously, as everybody knows, by statistics. But during this period of time, the top 17 mutual funds did 5% or more. But when you take a look at those top 17 funds then, they all experienced the great periods of time where those 17 funds that were with the very best over that 10-year period had periods of time where they were way underperforming. This is what this is showing right here. On a rolling quarter basis, of course, all 17 of the great funds in the world underperformed. On a one-year rolling performance basis, they were in decile 10, 11 of them were in decile 10, which is the worst performance. On a 3-year rolling performance, these 17 great funds were in decile 10, 5 of them were there over a 3-year period of time. So this continues what Warren Buffett had said in his analysis of the super investors of Graham and Garfield and their periods of underperformance. He talked about Sequoia Fund that had underperformed considerably for about 6 years, I believe, in that article. And of course, they were absolutely outstanding performers. So just the final thoughts that you need to be a very active manager to deliver good long-term performance. And the active share equation helps you identify those types of managers. The rise in passive managers making markets perhaps less efficient than they have been even in the past. And as value guys, we can take advantage of that. And the other, there's 2 things that I think is critical to being a good long-term investor. That is, you must absolutely think in terms of long-term. When I talk to clients, they want to know what long-term means, and they tell me, well, I'm sorry, but I can't think out 3 to 5 years from now. I'm going to retire. I'm getting older. I can't think out 10 years. When you really boil it down and you study what has happened to all these great investors over long periods of time, what long-term really is, it can be 10 to 15 years. And that's what is very difficult for most amateur investors to absorb. That if you pick a good manager, if you pick somebody who is great, you should have, and I can't tell clients this because they run out the door, you should have at least a 10 or 15 year outlook and stick with that manager. kind of interesting. Robert Kirby, he was a Capital Guardian Trust Company. Excellent, very smart with Capital Guardian. A great company, and done extremely well. A few years ago, he was giving a talk on how to pick a money manager, and he said, if I were to pick a money manager for my pension plan or my personal funds or anything like that, here's what I would do. I would use performance to pick the money manager. But he said, I would use performance in an inverse way. He said, here's how you value your money manager. You look at the money manager. Does he have a philosophy that makes sense, that is fundamental, that a philosophy that he sticks to throughout the period of time? Does he have a long-term superior performance record? And he's talking about a 10 to 15-year performance record using that philosophy. Does he have people in that firm who are smart and have been around a long time and are incentivized to stay in that firm and to work for that firm, and the firm has a good culture so people aren't going in and out the door? And he said, if you have all of that, then he would look at performance, and he would not buy any money manager unless the one he had terrible performance over the last 2 or 3 years, and that's when he would hire. So that's what we're recommending to our clients right now, to hire them. We haven't had great performance over the last couple of years, but the clients are not listening because it's a behavioral aspect. They just can't buy a non-performing, short-term non-performing money manager. That's the extent of that I'm sorry, but I did want to talk about that. Bruce, we said now there's some questions.
Yeah, I mean, I'll start off with an easy one. Is Deval Agarwal here?
Yeah.
You want to ask your first one?
Yeah, so I was just wondering what your strategy, when you make investments into the government financial, companies in the financial sector like Lamu and Countrywide, what was the rationale and what was the strategy of that program?
Yeah, all right. You mentioned WAMU, Washington Mutual. Yeah, the biggest saving law in the country is buy out everybody. And we're always looking at any of these companies once they have come down, 50% from their high or 75% from a high. That's our job to look at those and to consider them. From a standpoint of WAMU, briefly, I'm not the financial analyst, but I can give you some ideas here of the way we thought about it. Washington Mutual had $165 billion in deposits. Those deposits, they were paying, I think an average around 2%. So they had the ability to borrow money, $160 billion at 2% interest rate. Boy, I wish I could do that. If I had $160 billion and I only had to pay 2% for it, I would immediately put it into treasuries and get 4.5% and sit back and wouldn't have to do a darn thing. So the deposits are valuable, obviously, when you only have to pay 2% for it. And so that was a very valuable franchise that Washington Mutual had. The problem, of course, is where do you take that $160 billion and where you invest it in? If you invested in treasuries, you're not going to lose any money. If you invested in mortgages, yeah, you're going to lose some money. And we were looking at Washington Mutual and saying, okay, they have made some, the mortgage markets are terrible, the housing markets are terrible, the stock is way, way down. They obviously have made some very bad investments. We will take a look at that. And being conservative, Graham and Dodd guys, we will take what they've already done provision for, and we will double and triple and quadruple that. And then we will look at what happens to their equity capital when they take all those big losses. And then we came up with a number that Washington Mutual at that point was worth more 50% more than what it was trading at, so that's why we bought it. Subsequent to that, some things obviously got even worse in our portfolio than anybody could have imagined, and they had some very bad subprime loans and that sort of thing. But another thing happened to Washington Mutual, which we didn't anticipate. They had a run, and I believe the numbers were something like, in 2 weeks they had a run of $17 billion of deposits being pulled out. Everybody panicked. By the way, I find this amazing. This again is behavioral things. These deposits, of course, are FDIC insured. The people who are running anyway, taking their money out of it. And at that point, people panicked, the FDIC panicked, the government panicked, and shut them down, took them over. And so that's what happened to us in that case.
Mason Mallory. All right, I'll stand in for Mason. The Graham Dodd value investing style had a big influence on your investment philosophy when you started your company, namely the super cheap net type investments. But a lot of well-known value investors have modified Graham's style a little bit over time. For example, leaning towards higher quality companies. How has your investment philosophy evolved over time?
Okay, the assumptions in that question are not exactly right. First of all, to start off with, the Graham and Dodd philosophy wasn't just net by a long shot. There was a very detailed bond philosophy for the enterprising investor, for the defensive investor, on various techniques. He was always looking for new techniques. The net technique was not, was just one little aspect that he found in the 1930s as being unbelievably, because of the fact nobody had any money in the 1930s, so but basically these companies were selling for less than their cash on the books or so. But that was only a very small part of his overall philosophy. This philosophy basically is only got a couple of really simple things. It's that the public stock markets fluctuate in value a lot more than the underlying value of the company that those stocks represent. That the markets are behavioral. He was the first behavioralist, by the way. And that the markets are inefficient. And the markets are, by the way, markets are totally inefficient. Any of this efficient stuff that you read about and that is pure, total bunk. And anybody disobserving can figure out that it's bunk. How can you say a market over the last few years, or how can you say the internet bubble market was efficient? Or how can you say that the S&P from 2008 to March of 2009 was down 53%, and then since March of 2009 it's up 75%? How can you say that those are efficient prices and that they were actually reflecting the value of the companies underneath? It's ridiculous. It's totally ridiculous. All of Graham's philosophy is that you fundamentally, all you do is understand the actual value of the company that you're buying, and that's the philosophy. And then you look at the stock market only when it's on that downside, inefficient track, and you buy the company. So getting away from Graham and Doddism, no. We're pretty pure on the basic fundamental principles of Graham and Doddism. So I think maybe that question was referring to Munger's teaching and Buffett too, as far as the high quality companies that you're voting on them and that sort of thing. We haven't gone that direction. We're still more pure Graham and Dodd.
So you're looking at assets.
Yeah. But what they're doing, What they're doing too is also really kind of the same fundamental principles of Ben Graham are still following.
Okay, Ian Weber. All right, I'll do this one again. This is what I love about it. These are, unfortunately for us, these classes are paid, so I get to see them. You own shares in many major players in the tech industry, including Microsoft, Dell, Intel, Texas Instruments. How do you go about evaluating these kinds of companies? And why do you think your evaluation is better in these particular cases than that of the ones?
People have been looking at our 13 Ralph.
Well, I was hoping you would put me the financials questions instead of the tech questions. I could take a crack at it. We're always...
Yeah, take a crack at it.
So we're always... we have different investment committees. I sit on one of the investment committees. Charles sits on another one of the investment committees. All the committees see tech names come through on a regular basis, and we're always taking the steps to try to assess level of R&D in the business, take a guesstimate as to the potential return on that R&D, the returns on adjusted capital, embedding an R&D into the capital base. The same way, I don't know if anybody here is familiar with Credit Suisse. They have this Holt system which tries to capitalize everything on the balance sheet and then look at a really cash-on-cash return. We do some of that in tech. A lot of the tech names we own in the smaller cap committees are companies, when you capitalize the R&D, are trading at a fraction of, have good current earnings power and portfolios of technologies which seem to be able to generate decent returns in a runoff type scenario, even assuming there isn't a tremendous amount of return on the R&D that's been imputed into the business. On the larger cap companies, like an Intel, you look at the dominance of the moat that exists on that business and its ability to continue to be successful on the R&D front. I think there we would think about it a little bit more on a normal earnings, assuming that they're sophisticated enough to continue to get a decent return on the R&D that they're embedding into the business. I don't know.
Yeah, but
tech.
the stock prices went down, so we bought them.
Yeah, right.
Microsoft, in 2008, Microsoft sold like $30 a share, and then in March of 2009, it was trading at $15 a share. And today it's back up to $31, $32 a share. So that's why we bought Microsoft. It went down, and we bought them because of $30. I'm kidding.
All right, Amon Fenster.
Yeah, I'm here. But I forgot my question.
I meant, Bruce, I'm an underperforming money manager, so nobody wants to come. They don't care.
Oh, no, this is, it's just the ones who write the questions who decide they've exhausted.
I think I had a question about portfolio management. Is that right?
All right, I'll read yours. Many of the speakers in our class have managed very concentrated and sometimes equal-weighted portfolios. What is your portfolio allocation strategy, and how do you try and diversify to manage risk?
Okay, we keep it very simple and diversified and manage risk. Depending on how you define risk, we don't manage risk with defined as volatility at all. But we have to tell clients that we're going to be somewhat diversified, so we never put 20% in more than 20% in any one industry, more than 20% in any one country. On the global coast, because the U.S. is 40%, 45% of the index, we go 150% away from the index. And it's just kind of mechanical from an upstream. The allocations in the portfolio, we want to be, in some cases, volatile. We want to have volatile stocks to give us the opportunity. But from a diversification standpoint, we are in a whole bunch of different industries, usually in a whole bunch of different areas in the world. And so we, and in different currencies, of course. And from that standpoint, we're just kind of automatically diversified because we're finding things in various areas. But from that standpoint, we don't want to be diversified very much. One extreme example would be the late 1980s when Japan was 60% of the index, of the IFA index. We were zero, nothing in Japan. And we were thought that it was crazy and stupid. How could we possibly do that? Today, we are about double the allocation in Japan, and we're still thought, how could we possibly do that? It's stupid not to know that Japan is an economy that everybody's getting older and hasn't grown for 10 years, and there's no future for Japan. It's amazing. But, we will be diversified just on plain, but we don't try to reduce the risk as that question I think is defining.
Okay. Zooey Dream Zoo?
Here.
Okay.
My question is, GM is a company in your portfolio, and can you tell what is that GM, what do you think about the company, and after it's filed bankruptcy, what will you judge about your investments? What is your judgment? Like, how you judge it now when it's filed bankruptcy?
Oh, well, GM is no longer in our portfolios. We made a nice mistake on GM too.
Okay, and the question I think is, what if anything, did you learn from that mistake? What was the difference between your a priori analysis and that?
Yeah, here's the basics of why our analysis went wrong. If you look at the automobile cycle over many, many years in this country, at the top of the cycle, they're selling 17 million units, 18 million units. At the very bottom, historically, it goes down to about 12 to 13 million units a year. So, among all the other things, when we were analyzing the automobile companies, we decided that what would happen to General Motors, Ford, what would happen to them if they went down to 12 million units a year from the standpoint of all the analysis of their balance sheet and their earnings and their off-balance sheet obligations and all that sort of stuff, and compared to the price where it was then, we determined that General Motors would survive. What happened was that instead of bottoming out at 12 to 13 million units, it bottomed out at 8 million units, another 50% lower. And so our analysis that GM would survive was wrong. We knew they wouldn't survive at 8 million units. We didn't think that that was an all-time low, by 50% lower than it ever happened before. So we got caught on that.
Okay, Siddhartha Aluwalia.
Yeah. So I'm very intrigued by your firm's investment committee structure. How do you deal with situations when people disagree, given that it doesn't seem like there's any one person in charge?
Yeah, that's a good question. Committees never are good investors. You don't want to ever invest with a committee. But we have committees. So, Ralph, explain how that works. And why
Should we answer that as a committee? Sometimes discussions extend for a very, very long time on specific names where there's a lot of dissension. And there can be sometimes polarized factions. One group thinks no way to buy the banks. Another group thinks, yeah, they offer a very compelling margin of safety given all the external factors that exist. And, sometimes those differences, they're opinions and they're irreconcilable, and it takes 5 years to make a determination if one side was right or the other. And these things are probability tasks. There's no one specific deterministic outcome that's possible to establish for most of these companies. So I think it's challenging when you have those kind of polarized situations, and typically, the grandest way is to try to build consensus where it exists, and if there's enough consensus that there's a high margin of safety in a name, that it offers the price today offers a reasonable discount from an assessment of fair value relative to what else is available, we'll put it in the portfolios. The behavioral aspects of committees, I think, are really fascinating. So the tendency for groupthink, tendency for more extreme outcomes, the propensity for a personality to take over in a committee role. And in the past, I think we've had a few of those types of situations. And we make probably all the same behavioral mistakes that everybody else does. It's inevitable as humans to sometimes fall prey to that. Some of the things I think we do pretty well on the committee front is on the recruiting side. We, by and large, don't have real ego-driven, dominant type personalities who end up overwhelming the committee process. My compensation is in no way based on, do I agree with Charles or do I disagree with Charles? We're all entitled to have separate opinions, sometimes dramatically different opinions, and there's no repercussion, no consequence. So I think the way that you structure that, you let the more junior people go first. A lot of times when it comes to, well, what do you think about this name? This seems to be one that's relatively controversial. And it's something to make it an inclusive process. So I think there are mitigating factors that help us to avoid a few of the pitfalls of committees, but
Can I actually say something about that? Because in the past years, the way you've talked about these committees was an incredibly clever structure. And my understanding, Charles, when you first talked about these committees, the committees don't actually decide portfolio allocations. The committees decide intrinsic values. And I thought what you did was you all voted on an intrinsic value, so you got the benefit of the wisdom of crowds, in a sense. That the people who were too optimistic would be offset by the people who were not optimistic. And then, based on those intrinsic values, the portfolio managers would go off and decide what to allocate, having paid that attention to the committee. Now, obviously, if the average intrinsic value is above the price of the stock, that's something you would expect the portfolio manager to go out and sell. And the more, the bigger the margin of safety. Has that disappeared from these
That's
committees?
basically it, Bruce, but the portfolio managers don't make independent decisions. There's two parts of the committee.
Right.
There's the first part, which is determination of the value of the company, period. And when you go over that, then you evaluate it. You have a price on the voting table. You set. The second part is still the committee determines, but it's pretty easy because when you build a portfolio, you just build it from the price compared to the intrinsic value. You want to get the biggest margin of safety in the portfolio, so it's kind of automatic.
it's a mechanical, relatively mechanical process with the higher margin safety names on average having higher weightings than the lower margin safety names.
Okay, so that is still in place.
That's still.
Because I think that's unique to Brandis, right? That I know there is a truly benighted God, who I won't mention, who wants to benefit from the collective judgment of the value community. And what he does is he looks at their portfolio allocations and averages those. Well, what he's going to get is an average. Right? He's not going to get a superior result because when you average portfolio allocations, you just get the straight average of the decisions. When you average intrinsic values and then base the decision on the intrinsic values, that's a very different process where the errors are self-canceling, whereas they're accumulating in some average sense in the portfolio allocation. Right?
The other probably a problem that I see with that approach, the averaging of actual weightings, is that sometimes the actuals, we're not rapid-fire traders, and we'll let positions that have high margins of safety appreciate, and sometimes they become disproportionately larger percentages of the portfolio. I think most value managers do that up to a certain threshold where it makes sense, and there's a wide differential where it makes sense to reallocate those that capital into names that have significantly wider margins of safety. So it's not a super active trading type mentality. We only turn the portfolios every few years, which I think is relatively unique versus even some of our peers.
Okay, David Renninkmeyer. I got that right, close to right, David.
Pretty close. I noticed that a lot of your largest positions are in telecom. companies, both in
Yeah.
the U.S. and internationally. Can you talk about why you find that sector attractive right now?
Yeah, basically they're cheap. We're looking at telecoms now, especially the European and South American telecoms are quite cheap. We also own AT&T and Verizon, but they're not nearly as cheap, but we still we own them a little bit. Why do we own them? The negatives on the telecoms is that the wireline business, of course, is a declining business, and it will probably continue to decline. Well, I think that the market thinks the wireline business is going to decline faster than what we think it's going to decline. The wireline business also creates a lot of free cash flow right now. In the wireless business, a lot of these companies have both. The wireless business in developed markets is quite developed already. And the growth is going to be slowed down in the wireless business by a whole lot. Then if you go to the emerging markets, and some of the ones we own are in emerging markets, the growth there in wireless is still very, very rapid. But what we're looking at from the standpoint of price, on normalized earnings basis, we're looking at PE ratios around 7 or 8 times. Some of them we're looking at dividend yields of around 7% with what we believe is fairly strong free cash flow to be able to continue to pay those dividends. And we're looking at prices around book value. So that's why we own.
How do you compare those to the newspapers, which look a lot the same?
Well,
When Bruce Sherman was buying them.
yeah, I think that there's a world of difference in the fundamentals of how long businesses can stay intact in the type of business that it is. And there's a lot going on in telecommunications besides wireless and the wireline business, and there's of course all the PBA, all that. There's lots of stuff going on, and they have been somewhat good in changing with the times, technology-wise.
Alex Amarin?
In your emerging markets investments, is there any adjustment you make to your fundamental approach to adjust for risk, like political risk, that is pretty huge in some countries?
Yeah, we will do that for sure. And market capitalization rates will for political risk, corruption risk, and that sort of thing. We definitely take that into consideration when we're putting an intrinsic value on a company. And that would be companies located in that kind of area, the intrinsic value would be a lot lower than if they were in a developed market area. I don't know if Ralph, do you have any comments on that?
Yeah, I mean, emerging markets historically traded at a pretty significant discount to developed markets. And it's really only through this latest crisis now you've got the developed market for the most part trading at low teens type index multiples of earnings on a forward basis versus emerging markets which are in the mid-teens. So you've had a real crossover, and over a long period of time there's been some convergence in property rights and educational levels and infrastructure and things like that. But so corporate governance is significantly different still today in a lot of these emerging markets. Property rights are much less well developed in most countries. Even some of the, you look at the property rights in the BRICS, China, Brazil, maybe a little bit better than some, but we've actually had some bad experiences in Brazil owning the PN shares, the prefers that don't have a vote, forced takeovers at significantly lower prices without really any flexibility. There continue to be real corporate governance issues, which I think justify higher discount rates.
Chavez took over the telephone company in Venezuela, so we actually made money.
Yeah.
As long as I know, you guys blocked one of these PN and WN conversion shares in Brazil like 4 or 5 years ago, right?
Say the question, what have you...
I'm pretty sure like 4 or 5 years ago, you guys blocked one of the
We did.
shares conversion.
Yeah, we did. Are you referring to the Telemar situation?
Telemar, yes.
Yeah.
So maybe you know in more detail.
I don't have a whole lot of details on it, but it was a very, very bad deal for the sheriff. We fought it.
Yeah.
We won on that.
Yeah, we're usually not active, I think, by nature. We're not going out there trying to aggressively put shareholder proposals on proxies, push directors in. I mean, it's a very rare situation where we say, okay, something feels so inequitable and so obvious to us that we want to do something about it. And tell them our situation was one where essentially the PMs were going to be bought out, I think, well below the current stock price. And the control group was hoping to average down through, essentially, I think, stealing from the minority shareholders, which is what our clients own. So, yeah, we took it to court and we were able to block it. That would be a minority of situations that people were involved in.
Megan Johnson.
This is a question about financials, but I was wondering if you could talk about your thesis of owning some of the European banks like Deutsche Bank and UBS, and if you see any more opportunity there than with the American banks.
Ralph, I didn't hear the question.
UBS, Deutsche versus the American banks.
Oh. Well, you wanted to talk finance.
that was the last question, not this question. I'm trying to remember. I wasn't the analyst on those specifically, but if you look at where we've been seeing wide margins of safety in specific financial names globally, Japan is actually the area where we see some of the wider margins of safety, and then the domestic, regional, and more of the kind of the TARP reviewed, the stress test reviewed large cap banks in the U.S. So we've been overweight in the U.S., we've been overweight Japan, and underweight in the European markets. We felt the European banks there they were the least well capitalized out of the bunch, and so had significantly greater recapitalizations yet to come, and were under provision relative to what the NPL evolution was. And those two specifically, I don't know the numbers there well enough. I mean, those are relatively recent additions to the portfolios, so I'm actually kind of surprised they're already in public filings. But we've done the same bottoms-up work that we do on the other banks, where we've taken an interest in our clients, and we feel that topping off the delinquencies with appropriate reserves and core earning power of those businesses and capitalization levels justify exposures.
Megan, do you want to ask about pharmaceuticals too? Is that you or is that Manisha?
That wasn't me.
Oh, Manisha Kathuria. Okay. As of December 31st, 2009, the U.S. equity value portfolio has a 10.6% exposure to the pharmaceutical sector. In view of healthcare reform and other risks, how do you evaluate or reach that level of exposure?
Yeah, of course, it's very unusual for a value management fund. And we never have much ever in the 35-year history of the bank. We actually, during the Hillary care, when the farmers, actually during that period of time, the farmers during that period of time were trading about 30 times earnings. They're not value stocks, they never were. 25 to 30 times earnings. I can remember when Hillary Clinton came out with her health care thing, the farmers went down to about 15 times earnings, 15 to 16 times earnings, 17 times earnings. We were getting ready to buy them because they're good companies and good growth companies, and we thought at that point they couldn't be a buy, but we didn't buy them. We missed it, and they went back up after Hillary Care failed. So this time we were ready to go into farmers when they got cheap, and they got even cheaper than they did during the Hillary Care. And we're looking at farmers trading anywhere on our earnings estimate, and we capitalize R&D for farmers rather than expense R&D for farmers. And that shows, because we think R&D for farmers is going to produce something. The market doesn't, in today's prices, doesn't give any value at all that we can see to the R&D that the farmers are doing. So when we capitalize that, we're looking at some of the farmers we own at anywhere from 11, 10 times earnings, 12 times, 13 times earnings. And we do believe there is a future for pharma throughout the world. And we do believe that at those types of prices they're cheap. We own a lot of them. We own Santa Fe Venice, the French pharma. The Santa Fe has about 100, as far as their R&D, they have about 100 new drugs in development. About 30 of those are getting close to third stage of development. But the price of the stock doesn't reflect any of that future. The price of the stock, in our estimation, only reflects the cash flow that they're going to get from the present products up until they go out patent. And so we see more potential there, especially at the price where that stock is. It's down from its high of 2007. The Santa Fe price is down about 30% from that high. And so that's kind of our thinking on the other farms also. We've got some Japanese farms that are extremely cheap, and they are almost net cash. Some of the smaller Japanese farms, and they were in some of our smaller portfolios.
Francesco Bragiotti.
Right here. So my question is about the reading does buy and hold still work?
On what?
The reading you have written that does buy and hold still work?
Oh,
Okay. Asset allocation and what should basically a manager do? And we have heard that we should stay away from investing in obscure securities and we need to liquidity or complex vehicles and stuff like that. But on the other hand, you invested in one of the leading obscure investors, which is Royal Bank of Scotland. So I'm on which level does the investment stand? I'm confused. If you don't invest in an obscure stock, why would you invest in a stock that invests in obscure stock?
The question I think, Charles, is how does something like RBS become a buy and hold investment?
yeah. Well, it's none of our investments become a buy and hold forever compared to Warren Buffett because we are buying things that are not necessarily the pristine companies with the moats that will be around forever. We're buying them because they've declined so much in price that they have the potential of recovery, and then we're going to sell them. And sometimes if we buy them at a 30% discount and they go up, we can sell them within 6 months. Or we prefer not to have to sell them at all. We prefer to have the companies grow while we own them and the stock price grow with it. But to say it's a buy and hold philosophy forever is not necessarily what we do. We want to take advantage more, be more active, take advantage of the market fluctuations. That's why I was saying earlier we really like volatility because that's what gives us opportunities to buy them at a large margin of safety and And then you do, in my experience over a long period of time, these companies like Royal Bank of Scotland, which they're are, when I've been watching these markets for the last 40 years, the results are major recoveries a lot in a lot of these companies, and a lot of them don't recover. We did a paper, the Brandeis Institute did a paper on Catch a Falling Knife, it was called, and we did a study of every company that had gone down by over 60% in 1 year, and we bought them all, and your rate of outperformance compared to the benchmark in the markets was amazingly large. Just buying these companies and selling them as they went back up. So, but they don't always work out because they are companies that are under stress. That's the reason. In a lot of cases, they're under stress for one reason or another. That's why the stock gets so cheap in the first place.
I can just jump in. I think about that question on an intelligent investor basis, and we think about defensive investments that he talks about in Chapter 14. We actually sometimes a lot of companies come through the committees and we'll say that's a Chapter 14 company. Defensive characteristics, big cap, strong balance sheet, good solid, stable earnings generation, good dividend. I think about names like that and buying at the right kind of multiples, and you can probably just tuck those away in your portfolio and buy and hold them forever. You don't care what the stock price does. Then they're the enterprising investor, which the criteria that Charles talked about earlier. And there you have bargain issues of primary companies that are big, solid competitors in the market. RBS used to be one of those kind of companies. But because of all the problems that the UK faced, it deteriorated and became one of these workout situations that Graham talks about as one of the categories available to enterprising investors. And I would lump RBS by the time we got into it more along the lines of one of these workout situations, and there are multiple paths that can happen. We accept that there's a path that could potentially lead to zero, but we feel that the potential upside is high enough where there's justification for holding it at a small allocation, if it's a small allocation for us, at what we consider to be on a probabilistic basis, but a really wide margin of safety.
If you look at some of these, unbelievable how low they got and how they recovered that. Bank of America got down to $2 a share at 19. Citicorp got down to $1 a share, I think, something like that. They're trading around 5. They do recover. And we think some of these banks that we have in the portfolio have still great recovery potential further on. If you think in terms of might be a normalized banking atmosphere, say 3 to 5 years from now, they have, in that estimation, if things come somewhat normal for the banks, and they're not taking such big losses, and they don't continue to have, right now they have commercial mortgage and real estate losses, the single-family home type losses are probably kind of cleaned out, or we've seen the worst of those. But then if you look at the fact that, we look at the fact that the banks are going to need more capital, the regulatory due diligence, so their rates of return on equity are going to be lower probably in the next 3 to 5 years. But even if we look at that, and we look at a normalized provisioning, they could be making a pile of money. Especially a lot of the competition has gone away, that kind of stuff. I think, Ralph, you kind of agree with that, the way you're thinking on that.
Yeah, I think the financials are, at the presentation that I've done to clients several times, financials just another cyclical. And you think about all of the controversy that surrounds investments in financials, the operational and regulatory issues they faced over the last year and a half, they're now starting. And maybe they're not there yet. Maybe it's 2010 or possibly 2011 when they get to that point. But the returns on equity on new business that the banks are putting on, albeit it's not a ton, but every year 20% of the loan book rolls off and it's replaced with higher return on equity business. And their reserves are getting to the point where the system in the U.S. is one example, has the best reserves as a percentage of loans that it's had going back to the history that we have available from the FDIC, which I think starts in the 1940s, by a long shot. So you're going to get to a point where the reserves are reasonably able to cover whatever net charge-offs go through the system. And at some point, reserves are going to go back to a more normal level as a percentage of loans. So you're going to have a reversal of some of the provisions on the income statement. So you're going to have wider margins, reversal of provisions, and then they're going to earn excess returns the same way that every cyclical industry does when they're coming out of the trough. There's been a lot of capacity that's been removed from the system, and there's substantially greater pricing power, and that leads to excess returns for a period of time, and then the cycle is going to start all over again, and we'll do it again next time. Maybe we'll avoid WAMU or Citi. I think we started buying Citi around $30. I mean, if you look at individual positions, and it's clear, they either blew it or it was the low probability outcome. Maybe we didn't give enough rating to. Maybe it's just a cycle. I think we will go back and see what lessons are to be learned. My perspective generally on that is you do it once the cycle normalizes and you can get a really good statistical sample together to make sure we don't learn the wrong lessons and create heuristics that just simply put us in a bad position next time.
Okay, with that, we'll do one last question, and Scott Lee.
Actually my question was just 2008 was an extremely bad year for value investors. I guess, what was your most instructional investment and what was the lesson that you took away from it?
What was our most
instructional?
Which losing investment was the most instructional and what was the lesson?
What do you think about that?
Ending on a high note.
Yeah. I would say I would categorize them as industry areas. Financial area was one of them, and the automobile area was another one. In that the cycles were much bigger than what we were assuming, and that was pretty instructional that the cycle could be that big. I think one of the problems that we need to avoid, though, as investors, is that assume that the cycle we've been through is a normalized cycle, and the next cycle is going to be the same, and so we've got to be extremely careful about doing it. I think that assumption, I think we had a cycle that was very drastic as far as the credit markets go, and as far as some of the industrial stocks go. And I think if you're an investor who's going to be worried about the next 3 to 5 to 10 years, based upon what's happened in the last couple of years, I think you're going to make a mistake. That's somewhat like when I first started out, I had a lot of clients who had been through the 1930s. They never got over it. And, the 1950s and 1960s, 1970s were bad, but they were so conservative and they couldn't take advantage of really the economic growth and the market growth that we had seen because they went through the 1930s and traumatized them. It'll be interesting to see because this was drastic what's happened since 2007, 2008, first part of 2009. I don't know how many people are going to be traumatized, but as a money management firm, we're not going to be. We're looking forward to taking some risk, building portfolios that are active, and making money.
It's a good note to end on.
Thank you.
Thank you.
I'll see you later.
That's as close to risk-free as we can get. And unfortunately, I'm starting to run into that. So that was the one thing. Like commercial real estate, again, we're looking for communities. And they were very big. Basically, John
yeah, I think I'm in trouble. Yeah, it's always going to be.
Our
I don't know.
So you like the building the loss so we did that for Wells Fargo. Wells Fargo, and I think we may have actually brought good strong locations.
Other than few, you have to have a certain and that would be an operation.
What's your your background?
It's not just Wells Fargo, but mostly M&T, which started Walmart, and they moved to adjacent areas. And they went to Korea, which so we looked first at those banks, earnings power, and we said, okay, how much valuation are we going to get? And M&T was the only one we looked at. Wells Fargo, so we just now we knew that this was going to be a race when they have to turn out that race. And I think M&T so our big thing is it's good job. It's going to be very good. Although the rest of the I was like, well, the act is this or not, even though they are, it's to their discredit. We started thinking the model is coming out. And then if you want to get fixed, yeah, that's aspirational. You probably put more than 5% of your money. And I said, right. Unless, there were a lot of but we think of it as the closest ones. That's French. French. And I shouldn't say this.
So I sent him that a few days ago.
When the world transits, that generates just as we that position should have been black in 08 and 09 and it wasn't. It was pared back a little to our credit. It was pared back a little. But we buy all the stocks. Take the money. Yeah. Too bad it's only euro. It should have been blown out. You got the picture, right? Exactly. Yeah, I did. As I say, the problem was they're in transition. And they were frozen this year. There are a whole bunch of things that no downside, huge upsides. You had the arguments. We didn't sell the gold. Are you still and our philosophy is the gold is insurance. And when the house burns down, we should take the insurance. And build a new house. That was the vision.
Yeah, that would be a strong policy that we the fire has. Are you going
as well? Okay. We could. And think about it. We should have done it. Yeah. Rebuilt the gold position. And as the VIX came down, if you most need insurance, everybody needs the gold. And anyway, yes.
It seems unlikely at this point.
We'll shoot me an email.
You really want to do round 2 on that? I mean, I think we know what the issue is, right?
Yeah, but I disagree with you. The reason I made it structured. I think it's like almost weird. So
you're doing something for her direction. You're doing something.
Your argument.
You've fallen in love with this stuff.
No, but
We
it's
fell in
not
love with it
argument.
based on one set of reasons.
That's not.
It turns out there are big problems with those reasons. Look, the worst thing about these guys is they're not good capitalists. They don't understand where they should spend. They don't understand market share.
Yeah,
There are market share. There are local market share.
You're a 4% of your cost base.
There's a size in that market, margins should be relatively.
No, because you got to big fixed overhead.
Yeah, but that's what I'm saying. It's not really, it's only people. That doesn't
Right, but people cost me money.
Yeah, but there's only a 12 to 18 month lag.
No. The point is, suppose we are we got sales guys calling them, brokers calling them, lawyers closing. We got to have that same infrastructure to serve these guys. Now that's sales. So it's 20%, but let's so we got that's 20% of our costs in Dallas for scale. They are we're 4% now. And our competitors are 40%. They got that cost spread over 10 times as much. So if it's 20% for us, it's 2% for them. And that means they got an 18% cost.
I'm still not sure. What is
You had better find out. What I'm much more worried about is not this investment. What I'm much more worried about is your changing your analysis. No, you said something at the beginning.
Yes.
And you now decided it is wrong.
Yeah, no.
And you start doing that because you fall in love with these investments.
Yeah, but I go back to the probability of being wrong.
I would not make this investment. They don't understand local concentration and local knowledge. These are not.
What do you, like, you want to go someplace like a hotel, or you want to?
Now, you may want to go ahead anyway. But normally they want people who understand the economics of the business.
Okay.
Yeah.
Going all over Helen Don is never a good idea. Charles, that was terrific.
Thank you.
That was great. That was great fun. And I think, do you mind coming back with, okay?
Oh, that
Yeah, no, that'd be great if you come together.
Yeah, it was fun.
Yeah.
It's fun to be back. But it's, I'd forgotten that.
Again, what I'm much more worried about is your self-discipline than anything else.
I had forgotten that Jamie and Clayton.
If you start falling in love with it,
No, I don't
They
really.
were sitting right there.
And just more because
Was,
I understand your argument.
started
And I have to do more work to understanding how many sales associates for what market that they need. The way I understand what we're talking about, the lawyers, the way it's set up, is they don't really have a relationship with the sales associates. They have really underwriting.
Yeah.
They don't call the sales associates.
yeah, but how do they get new business?
Well,
In a market.
So
How do they get new business in a market?
when four firms control 90% of the market, there's not much new business. And
Right, so if they're
the lawyers come to the underwriters.
So if they've got an underwriting structure in Dallas, and they've certainly got to check the title in Dallas. So they've got an infrastructure and they got 4% of the market. But they're not going to make money on that market. They're way subscale.
Yes, if they actually got into the market. So the question is when they got into the market.
We saw what their shares were. We're good enough to print those out.
Yeah, I mean, and
And they're subscale in all those markets.
Yeah, maybe somewhere, if there's anything close to them.
Yeah.
Well, what's the place that
the
used to
thing
be?
that's the reason why I think of
That's
I'm just saying what you told me.
Chicken and beans?
No, I said,
Now you've decided you're going to look at it again. That's not good for your investment. It's not a way to do investment thesis.
Yeah, but if you look at the full-time employee and
It's not just that. You've got to have people, local contractors who will track the titles. You've got to have a presence. You've got to do the
San Diego's want to go to Texas.
So at least when we did this diligence for
How in the know?
The only places I know around here are all bars.
10% minus firms in a
You
month.
get deep fried food, French fries.
Yeah, not so much.
So, and if these guys in most of their markets are less than 1% share, why does that suddenly change for them?
There's 4 big markets.
No, but it doesn't matter. It's a local business.
Yeah, it's a local business.
So don't keep telling me that.
Bruce, we're gonna get a quick bite to eat somewhere maybe around here.
I would love to go with you. Take a but you know what? Let me go with you, and I'll join you there because I have to take care of this. My hip is killing me. Let's go to the Long.
That's what I was thinking.
It's sort of a Columbia hangout.
Oh, that'd be great.
French place.
All right, that's
Okay, so but I really care much more about your discipline. So look at this.
Sorry, I'll keep arguing.
I don't argue with you. You gotta learn to argue with
enjoy the
yourself.
discussion more than Thank you so much.
It's 112. Between 112 and 113. Little towards 112.
So we can walk. Yeah.
You could walk. I'm going to have to take a cab. Then I'll just come back here and go to work late at night.
I gotta do some work on it.
Because I've got to, we have a $2,500 prize we give out for the best paper.
Oh.
And I'm in the process of reading them all to, we have so much prize money. We have two $25,000 prizes.
Yeah, you have the Persian
We
Square.
have the Persian Square, then we have another group that picked out a prize. It's going to be next week. Bill Ackman did a $25,000 prize. We got another person who did a $25,000 prize. That's all. We have $2,500 for the best paper.
Well, tuition is, what is tuition now?
55.
Tuition is 55? Plus living expenses?
Plus living expenses. That's 70.
That's twice what we paid when we were here just 10 years ago. That's
Because every time we look at the financial situation, we say, nothing, a 7% tuition increase for you. As we're here, and when you turn down 7 out of 8 customers, a lot of pricing power.
Yeah.
Okay, so I will see you there. I'll see you there. I'm
That's
there.
It's on Broadway, right?
It's across from the
Yeah,
house.
I know where it is. See you there.
Okay.
Yeah.